Smart money concepts are blowing up in the trading world right now. They take pure price action and combine market structure, order blocks, liquidity, and imbalances into one powerful trading framework. But here's the problem. When you try to put all of this on a chart, it can get messy. For beginners, it feels overwhelming and can take months to figure out. That's why in this video, I'll show you an SMC indicator that automatically highlights these concepts on your chart, making it 10 times easier, especially if you're new to trading. And on top of that, I'll also break down a powerful smart money trading strategy, step by step, that can seriously boost your win rate when used correctly. We always appreciate your support, so please give this video a thumbs up and subscribe to our channel if you are new. Welcome back, traders, so let's get started. To apply this indicator to your chart, simply open the Indicator tab. Search for Price Action Toolkit by Flux Charts, and click on it. Once added, you'll immediately see that many of the core smart money concepts are automatically mapped out for you. Market structure elements like break of structure and change of character, along with order blocks, fair value gaps, inversion FVGs, and liquidity areas, are all highlighted directly on your chart. This makes it much easier to track the price action without manually drawing every single zone or structure, saving you both time and effort. Once you open the settings, you'll find a wide range of customization options and smart money concepts features that you can adjust and apply to your chart. At first, this indicator may look advanced, especially if you're new to trading or just starting to learn smart money concepts. But don't worry, in this video we'll break down all the essential concepts and terms you need to know, and then show you how to apply them in the trading strategy I'll share at the end. First, we'll start with the market structure elements. To mark them on the chart, go to the Settings tab and enable the BOS and CHOCH boxes. As you can see, BOS is shown in green and CHOCH in red on the chart. These two are the most important concepts for mapping market structure, and you need to fully understand them before analyzing any chart. BOS stands for break of structure. In an uptrend, whenever price breaks above a recent high while protecting the lows, a BOS is formed. This signals that buyers are still in control and price is likely to push higher. But if price fails to protect the most recent BOS low and breaks below it, that shift creates a change of character, also known as CHOCH, signaling that buying momentum is fading and the market is likely to reverse direction. Here we can see that price was in a strong uptrend, creating several bullish breaks of structure by pushing above each higher high. But once price broke below the most recent higher low, it formed a change of character, signaling that the uptrend was coming to an end. The next key concept is the fair value gap. To display it on the chart, simply enable it in the Settings tab. As you can see, the gaps appear automatically. A fair value gap forms when there's inefficient price delivery, usually when price moves rapidly in one direction without meaningful pullbacks. They often appear as gaps between candlesticks, and they act like magnets, because price tends to revisit, fill, or rebalance them over time. I recommend increasing their sensitivity to 6 points. This filters out the small gaps and highlights the larger, more important ones, making them easier to see on your chart. And for those who don't fully understand what fair value gaps are, or the psychology behind them, let's do a quick recap. A fair value gap usually forms within a 3-candle sequence and is easy to spot on the chart as a large impulsive candle. The key feature is that the wicks of the candles on either side don't fully overlap the body of the middle candle. This creates a visible price void, known as the fair value gap zone, which is drawn from the body of that middle candle. Price often comes back to rebalance this zone, making it a strong area of interest for traders. The next key concept to understand is the inversion fair value gap. To add these zones to your chart, simply enable them in the Settings tab. For more accuracy, I recommend setting the invalidation method from wick to candle close. Now, you might be asking, what exactly is an inversion fair value gap? An IFVG forms when price disrespects a regular fair value gap, meaning instead of reacting to it, price breaks and closes straight through it. When this happens, The original FVG flips its role and often acts as a new support or resistance zone, depending on the breakout direction. For example, when price breaks straight through a bullish fair value gap without showing any respect or reaction, the gap flips its role and becomes an inversion fair value gap. Now, instead of acting as support, it's more likely to hold as resistance and create opportunities to go short. That's why highlighting inversion fair value gaps on your chart gives you valuable clues about where price is heading and what's likely to happen next. Next up, we have the order blocks. Let's check the box and see how they are applied to the chart. Now, we can see multiple order blocks displayed. From observation, it appears the indicator marks the last bearish candlestick before a bullish impulsive move as an order block, and similarly, the last bullish candlestick before a bearish impulsive move. However, with this definition, many potential order blocks are filtered out and not marked on the chart. These marked zones are considered our POIs, points of interest, specific price zones on a chart where market reactions are likely to occur. So, essentially, when the price returns to these order blocks, we expect a possible rejection and look to open a trade. The indicator uses a unique method to identify these order blocks, showing only those confirmed by market structure and trading volume. However, determining their win rate would require extensive backtesting. Additionally, we must look for the entry reason and confirmation in the lower time frames. Now let's put all of these concepts together by breaking down one of smart money's most effective strategies, the inversion fair value gap in fair value gap. To apply this strategy correctly, you'll need to work with two time frames. First, use a higher time frame to analyze market structure. Here, you'll look for a change of character and the fair value gap connected to it. Then, zoom into a lower time frame to spot reversal and confirmation signals. This is where you'll look for inversion fair value gaps and identify your entry point. Now let's go step by step and see exactly how this plays out. The very first step is to analyze market structure on the higher time frame and determine whether price is in a strong uptrend or downtrend. To confirm a strong uptrend, you need to see at least 3 consecutive bullish BOSs. On the other hand, to confirm a strong downtrend, price must form 3 consecutive bearish BOSs. Once you've identified that, the next thing to look for is a higher time frame change of character. For example, in a bullish scenario, if price breaks and closes above the most recent BOS's high of a strong downtrend, it signals a bullish change of character, suggesting that sellers are losing control and the market is likely to shift direction. Now, once a market structure shift is confirmed and we expect the price to move higher, the next step is to look for a buying opportunity. At this stage, we focus on spotting a bullish fair value gap that forms within the change of character's leg. As we mentioned earlier, FVGs often act like magnets, pulling price back in before it continues upward. So, after identifying the higher time frame CHOCH and its fair value gap, the next step is to zoom into the lower time frame and wait for the price to return to that higher time frame fair value gap. Then, closely monitor price action inside the fair value gap and look for any sign of rejection. This confirms that price is respecting the higher time frame gap, and that's your first layer of confirmation. Once you have that, the next step is to look for a violated fair value gap that flips into an inversion fair value gap, either inside the higher time frame FVG or just outside it after the rejection. This becomes your second layer of confirmation. When this inversion fair value gap forms, it often acts as a new support zone, and that's the area where you look to open your position. If a market structure shift also occurs at the same time, that adds another powerful layer of confluence, making the setup even stronger. This market structure shift tells us that the temporary bearish move is ending and bullish momentum is likely returning. At this point, price is expected to realign with the higher time frame trend, which is now bullish. With all these confirmations in place, we can now expect that price will return to the zone of the inversion fair value gap, which now acts as a support, before continuing upward. Next, to open a trade, place a buy limit order at the midpoint of the newly formed inversion fair value gap. Your target should be the nearest buy-side liquidity on the current time frame, or if you're aiming for a bigger move, a key level on the higher time frame. As mentioned before, this strategy works with 2 time frames, I usually combine the 1 hour with the 5 minute for this setup, but you can also use the 4 hour with the 15 minute, or even the 15 minute with the 1 minute. The key rule is simple. Your entry time frame should always be at least 2 levels lower than your main time frame. That's it, traders. Thanks for watching. I hope you found this video valuable. If you did, hit subscribe and turn on notifications so you never miss an update. Drop a comment below with your thoughts or topics you'd like to see next. Your support means the world to us. See you in the next video.